AMC is down about 2.26% at the time of recording this video, and the S&P 500 is currently up 0.82%. And a lot of this, pretty much all of this, is due to Apple and Amazon earnings, which were by and large decent. They weren't great. None of the earnings we have gotten have been great, but they have been better than what they could have been. And that's what I think the markets have been paying the most attention to. It's, are we getting that worst case scenario? You know, Apple, Amazon, they could have came in with big misses, and that would have produced a big downside move, but we didn't get those big misses. We definitely didn't get a lot of the beats that we were expecting at a lot of companies. Google, Microsoft, Facebook all missed estimates. Amazon missed EPS estimates. Apple missed on a lot of different metrics, right? So it wasn't that good in the grand scope of the expectations the markets had, but long story short, the earnings could have been a lot worse. And that also is really starting to push back at that whole recession narrative, because yesterday we also did get a negative 0.9% Q2 GDP read. Now, obviously, those are advanced estimates, so we're going to get revisions. Like Fed Jerome Powell said, it's hard to calculate the overall GDP of a large country, a $20+ trillion economy such as America. So there will be revisions, but it will still remain negative. I would be very, very, very surprised if the GDP somehow for Q2 was revised and actually went positive. The estimate for that Q2 GDP result was a positive 0.3% gain. So we completely flopped on the GDP report. Now, good thing is Apple and Amazon had good earnings. So it's kind of offsetting each other, because how do you see a recession if Apple and Amazon are reporting these revenue numbers that they are? That shows the consumer's not slowing down in a big way like people were expecting. So that is really what is happening today. A lot of people look to those earnings and they're saying, hey guys, this is not so bad, and maybe these multiples make a little bit of sense. But what the Fed said on Wednesday is really going to characterize this market over the next couple of months. You could call it the next month and a half at the very least, until we get close to the September 21st, 2022 Fed meeting. We don't have a Fed meeting for August. The Fed, I guess, goes on vacation around August every single year. So we don't have a meeting in August. We have the next one September 21st. So you're going to get two readings of everything. 2 readings of CPI, 2 readings of PCE, 2 readings of unemployment data. 2 readings of basically everything. So we're going to get a lot of data. And what the Fed said is that they would not be opposed to another unusually large rate hike. They didn't say whether that would be 75 basis points or 1% or possibly higher than that. They just used the words unusually large rate hike. And the Fed also did say that they plan to slow down raising rates eventually, and the markets kind of ran with that, and the markets are pricing in a 50 basis point rate hike. But the Fed did reiterate, if that CPI report comes in too hot, PCE comes in too high, if the overall economic data looks good, and the Fed has room to keep raising rates, and they have to, well, that's what they're going to do. But the markets kind of picked out what they wanted to and ran with it. A lot of analysts were calling out the fact that you could have looked at the Fed press conference. You could have looked at the report and made out a bullish case or a bearish case. Whatever narrative you wanted to pick out, you could have picked out. My personal opinion, it seemed pretty bearish for the next, weeks and months. Really throughout the rest of 2022, you got no indication that the Fed was going to slow down raising rates unless the data showed that the Fed could slow down raising rates. But the simple fact here is that inflation is too high, and any other time in history, you have had to get the federal funds rate up close to as high as the inflation rate to get inflation down. Take a look at the federal funds rate overlapped with inflation, and you will see, hold on one second right here. overlap this with inflation, edit graph. Do inflation in here. Oh, they're gonna really make me type in the whole thing. And you got to get inflation, well, the federal funds rate up pretty close to, if not above, the rate of inflation to get inflation to come down. So it doesn't look like that's probably going to happen. The federal funds rate usually has to go higher than the rate of inflation. You guys even seen this back in 2019. Inflation, around 2-3%. Well, the federal funds rate actually went above the rate of inflation, and then we got a recession, and inflation obviously went way down until this spike, and the inflation is obviously the red line that we started to see throughout 2020, 2021, and now 2022. So you guys can see what this overall picture is telling you. The blue line, federal funds rate, has to get higher than inflation, or at least match what inflation is doing. So if the reports we're getting, if the data that is coming out is showing inflation is not going down, the Fed is not going to stop raising rates because the economy is slowing down or going into a recession. That's the bottom line of what I got out of the Fed meeting on Wednesday. And we just got the PCE data. And that is the inflation figure that the Fed follows closely, just hit its highest level since January 1982. Key points: the personal consumption expenditures price index rose 6.8% in June, the biggest 12-month move since the 6.9% increase in January 1982. Excluding food and energy, so-called core PCE increased 4.8% from a year ago, up 0.1 of a percentage point from May. The employment cost index, another figure Fed policymakers follow closely, rose 1.3% in the second quarter. The index climbed 5.1% on a 12-month basis, a record for that data series that goes back to 2002. So what we just got out of the PCE is that inflation is not slowing down. Regardless of commodity prices rolling over the last month or two, you're still seeing inflation. And the Fed's favorite data point, which is PCE, core PCE especially, it's not going down, especially not how the Fed wants it to go down. So what you're seeing right here is a greater likelihood of getting a large interest rate increase coming September 21st. Now, depending how the next couple data points come out, that is going to move the markets most, and that is what is kind of pouring some cold water on the market rally as of right now. It's the markets realizing that inflation is still the main problem, and the Fed raising rates is really going to hamper growth at some point. Keep in mind, great earnings are wonderful, right? Apple, Amazon has great numbers for Q2. That's all fine. Investors care about what is going to happen over the next 3 to 9 months. And the 9-month picture here, or call it the year outlook, doesn't look that good in my personal opinion, when the Fed is going to have to raise rates over and over and over again to get inflation under control. And the markets, it's a ticking time bomb once they actually start to realize that that is what we are currently faced with. So that is the big data point that came out today. PCE was way high, and that's why you're seeing, that weird sell-off in the beginning of the day, and then a monstrous rally, and then ever since about an hour ago, we started to slowly sell off, and that's where we are right now. Even since the time of recording this video, we're down about 0.30% on the S&P 500, now sitting positive about 0.60%. So that is that. That's what you guys need to know. As far as the Michigan Consumer Sentiment Survey, personal income and personal spending, all of that came in pretty much at expectations. You did see a boost to the personal spending rate just a little bit, so that could be seen as a positive thing. But still, Americans are going through their savings, and they're not saving as much money right now. Only 5% of personal income is actually being saved. That is almost at a record low. Usually you don't see people only saving 5%. Typically, it's much higher than that. Now, as far as the yield curve inversion, you're still inverted 24 basis points. So regardless of what the Fed said, regardless of anything else going on, investors are still pricing in some real short-term pain to come, with investors selling off the 2-year bonds, driving 2-year bond yields higher, and buying the 10-year bonds, driving those bonds lower. Well, that's how you get a yield curve inversion. That is signaling that investors don't want 2-year bonds, and they want to get paid out more interest, and that is why you get the 2-year bond paying you out more than a 10-year bond. That is the yield curve inversion, probably the most infamous signal of a recession to come. Yield curve inversion, 2 negative quarters of GDP decline. I mean, you could say that the White House has no idea what they're talking about when they're coming out and saying that we're probably not heading into recession. It's obvious we are heading into recession, even if it does take more time than people did realize. So that is pretty much all that is happening for the day. In a nutshell, we already went over Apple, Amazon earnings. They were decent. They could have been worse, and that's the market narrative that you are hearing on Wall Street today. Now, as far as AMC stock, we're down about 2.81% at the time of recording this video. I will tell you guys right now what is really moving down the price of AMC here today, and quite frankly, a lot of other stocks. Really, from what I could tell in the markets today, it's your large companies, your Apples, Amazons, that are really carrying the indexes higher today. A lot of stocks in your personal portfolios are probably red today, just like a lot of my stocks in my portfolio are red today. But you are seeing a lot of negative option activity for the day. 7 orders totaling $317.93,000, positive order value of 23%. So obviously not too positive, and those options are really helping to push down the price of AMC stock. As you guys can see, these September 16th $14 puts coming through for about $54,000 a piece. This looks like one single hedge fund that put all of these orders in. Pretty much back to back to back, $14 strike. You're more than likely seeing that as the main cause that is pushing AMC stock down. I don't really think there's a lot of FOMO right now, obviously, for AMC or for any other, quote unquote meme stock. The FOMO's kind of going to come and go. The attention to a certain security will come and go, but there is a lot of resiliency you are seeing in AMC's chart, which we will talk about that in just 1 second. Now, the dollar amount of shares that is currently sold short is worth about $1.47 billion. Estimated short interest of free float is 19.59%. The free float out on loan is 28.02%. Shares out on loan 144.45 million. Days to cover 3.43. Cost to borrow 9.71% and 100% share utilization. You could see the cost to borrow max sitting at 9.6%, or cost to borrow max sitting at 10.49%, cost to borrow average at 9.6%, and cost to borrow minimum at 6.56%. So not a lot of changes here with the data, but I do want to point out almost a 20% short interest still. That is very high, and I imagine on days like today that number is creeping up ever so slightly. I imagine there's probably not a lot of people at this point that are selling out of AMC stock that have not already sold out. Like, if you have been in the stock this whole time, ever since we went, negative, even under $10, we went to $9.70 per share. That was actually the low. You probably sold out during that time period. That's probably when you got freaked out and scared out of your positions. I doubt people are really getting scared out of their positions right here and right now. And I do still want to point out that AMC is in a very obvious uptrend. Why do people like to use the 50, 100, and 200-day moving averages? Well, it shows you trend above anything else. And for the 50-day moving average, we only went above the 50-day moving average right here in March during this last rally. So not a very long period of time. But before that, you were not above the 50-day moving average since November of 2021. Well, we're above that right now. We're firmly above that right now. Let's go ahead and take off some of these lines to make it a little bit easier to see. We're still above the 50-day moving average. So we have broke trend, and now we're in a bullish trajectory. We're in a bullish trend as of right now. If you really wanted to get super technical, draw a line from the lows, you're trending to the upside. As long as we hold above the 50-day moving average, that is bullish in my personal opinion. That is a good thing, especially as this 50-day moving average will continue to move higher and higher. That will start to really push us in between the 100 and 50-day moving averages, and then I think we will get another break to the upside above that next moving average, which is this orange line right here. $15 per share, that's going to be the next level of resistance that we need to break out above. I don't think it will be all too hard to break out above that, as we do see the RSI is at 47.69. Definitely has a lot of room to make its move to the upside. Potentially a lot of bullishness that could come into the stock next week around earnings, which is going to be on August 4th. And any technical signal here says, hey, you got a lot of room to move to the upside. The stock is probably getting close to those oversold levels. It probably shouldn't have sold off this much this fast, right? Over the last couple of trading days, you have lost over $4 per share since the peak at $18.37 per share. MACD still extremely bearish as well. Volume sitting at about 7.5 million. So even 2 hours into the trading day right now, that is a very low volume day. Like I said, August 4th, I think that is going to be the next time period in which that we will probably get some bullish information that could lead to a bullish rally in AMC stock. We will talk about that more, especially over this weekend. So stay tuned for that. Hit that like button, subscribe to the channel if you guys have not already. Comment down below what is your thoughts on all of this information, and if you guys want to come trade with me live in real time, link down below in the description as well. You guys enjoy the rest of your day, and I will see you in the next one.